Okay, guys, we got the FOMC decision going live in about 45 minutes. Let's put a timer up. The big question I think today, there's a couple ones. Number one, we're obviously going to be cutting rates 25 basis points going live in about. Listen, I could troll you guys or try to be like, ooh, will we cut rates? We're probably cutting rates. I think the last time I looked at the odds, there was like a 0.1% chance of anything outside of a 25 basis point rate cut today. And so I think number one, just heading into this meeting, I'm not going to sensationalize it. We're probably cutting rates. Now, the odds have actually decreased a little bit. There's always a chance. Nothing is impossible in markets. Something could always go against the probabilities. But at this point in time, we got a 98% chance. It actually went down a little bit, but still 98% chance of a 25 basis point cut right here. About a 2% chance of a pause today, which means it's probably not freaking happening. Bitcoin dropping down to 111s. S&P, NASDAQ, close to all-time highs. Some of them broke all-time highs this morning. Apple, a lot of stuff pulled back since the opening bell, but a lot of stuff is really net flat on the day. The big question, there's going to be two major events from this FOMC meeting. There's going to be two major things to pay attention to. All right, number one, again, we're probably cutting rates 25 basis points, right? This isn't number one. This is just, we're probably cutting rates 25 basis points. The first major thing to pay attention to is during the statement release at 2 p.m. Eastern Standard Time, they should be announcing an end to quantitative tightening, and specifically when that's going to be. It could be at the end of this month. It might be in December, but at the very least, they should give us an update on when they're going to end their tightening cycle that they've been doing since 2022. They reduced it a couple meetings ago, 80% in treasuries. They kept MBS QT the same. They reduced it by 80% in treasuries a couple meetings ago. And now we're going to be getting into when the full thing is coming to a stop, right? And just to put this into perspective, quantitative tightening is when the Fed reduces their holdings of treasuries and MBSs. They're doing what's called passive QT, or they've been doing what's called passive QT, which is when they just kind of let it mature and run off and slowly reduce their balance sheet by letting their bonds mature and run off, but versus direct QT, which would be directly selling their treasury bonds, their MBSs and stuff like that. But they're going to reduce, or they're supposed to stop the reduction of the balance sheet, which means that it's not quantitative easing. I see a lot of people screaming QE. Oh, we're doing QE. We're not doing QE. Okay, ending QT doesn't mean QE. Okay, like the Fed can keep the balance sheet even by, if one matures, then they buy back another one, right? And they keep the size of the balance sheet the same. That wouldn't be neither QT or QE. It would just be neutral. That's very possible to happen. It doesn't necessarily mean we're getting quantitative easing, which is money printing, where they create online money and then buy bonds and other financial assets with it. We're not necessarily getting that, but an end to QT is a dovish, less restrictive, loose thing that JP Morgan predicted we'd get an announcement for that today, and that's probably true. That's what most people expect, but watch for that. Again, that's going to be during the 2 p.m. release of this report. I can show you what the last one showed here. Again, if we take a look at what the last FOMC decision showed, here's the text from the last FOMC decision 6 weeks ago. And again, this update, I'm going to cover it probably before you'll be able to see it. But they talked about the quantitative tightening that they were doing here. The committee will continue reducing its holdings of treasury-backed securities and agency debt and agency MBSs. They seek to commit supporting maximum employment, returning inflation to 2%. But again, this is probably where the end of QT will be announced right here and on the new page, right on the new page that's coming out. But again, you can kind of see that here. Very relevant to watch and very important to pay attention to. Again, will the Fed end quantitative tightening today? I believe the president's also speaking right now, just to clarify. I'll put a timer up. We got about 40 minutes. Yeah, we got about 40 minutes until the FOMC decision. Here is a timer for that right here. Yeah, I would assume Bitcoin would go up. Bitcoin wants easing, correct? So they want money printing. I don't think we're going to get easing, but I think we'll at least get the end of quantitative tightening today. I don't know if they're going to end it this month or next month or December or when they're going to do it. But just the announcement's the catalyst, when they're ending it. NASDAQ's obviously been choppy and flat leading into this report. And again, this is coming in the midst of a government shutdown. Today would be day 29 of said government shutdown. And Yeah, again, today would be day 29 of the government shutdown. Now, there's a couple big deadlines coming up that, I hope we get a deal done this week. I think the Fed, or I think the government, obviously has some big deadlines to hit this week, avoiding SNAP and, which is food stamp expiry, which would be November 1st. Technically, it's Saturday, but I think they're going to try to get a deal done Thursday or Friday. At least I hope they will. Maybe it's confirmation bias, but I hope they're going to get a deal done sometime soon. The historical longest shutdown was 35 days. Now, to understand the context of the last shutdown that was 35 days long, you have to understand most of these budget deals had already been done. The shutdown happened, in around December, and so they had already agreed on the budgets and everything like that. So it wasn't as dire as this current one. The last one from 2018, 2019, one of the reasons it dragged out so long is because we had the Christmas holiday break, right? So the people we needed to get together, they were on break, essentially. This was a little bit different. This one, we weren't able to get a deal done by September 30th, and so we didn't appropriate a lot of the things we needed to avoid disaster, right? So this was a little bit more dire, I would say, than even though this one's technically shorter than the longest one in history, which was 35 days in 2018 and 2019. And again, it's 2018 and 2019 because it went through New Year's. But this one's a little bit more dire because we did not negotiate any of those things. And stuff's about to run out. And so it's a little bit more serious, I would argue. This one specifically. Yeah, I mean, I think it's pretty likely he's going to end quantitative tightening sometime this year. He said 2 weeks ago during the press conference that they were doing, he said that they would probably announce an end to quantitative tightening. I believe the exact language he used was in a month or two, right? That was about 3 weeks ago, but he's probably going to announce when they're going to end it today is my guess, Again, y'all do me a favor, hit the like button, hit the subscribe button. Hey, what's up, Dennis? I'm doing good, man. Welcome. I just want my invested money. I don't want profits, though. Honestly, look at the NASDAQ dip here. Yeah, we got Jerome Powell speaking. Again, we're going to stream the entire thing live, as we always do. Hit the like button. Let's bump the likes up. Will the dollar get supported if they end? Hold on. Let me look at the NASDAQ breakdown here. I'm trying to see if there's any news causing this breakdown in the NASDAQ. Yeah, I know the president's speaking right now. Maybe that's driving the market down from this. Yeah, give me a follow on X.com. He said that the Fed was going to start unwinding gradually last meeting. Let me see exactly what he said. I'm pretty sure it was deeper than that. He's already been unwinding quantitative tightening. Or just to put this into perspective, right? Like, they've already started. Okay, so this must have been like 3 or 4 meetings ago. They reduced the reduction of treasuries by 80%. So they reduced the QT of treasuries by 80%. This must have been like 3 or 4 weeks ago. They kept MBS QT the same. And then I believe the last meeting he said, let me look this up. I think the speech was on October 14th. right, look at this drop. Is this from the president speaking right now? Hey, what's up, Bulldog, my guy? Thank you, man. Appreciate it, brother. Well, one's tech and one's not. Remy, most likely. Remy says, why do investors like Apple and not United Health, despite both of them sitting on cash? Probably one's tech, one's Mag 7, the other one's not. I mean, I bought UNH at 240s, you know. But it's had some swings since then, for sure. Alright, look at this drop. I'm trying to see if it's the president speaking. Yeah, it's got to be the press speaking. I think he's speaking right now. Like, I'll play it if he is. I don't think he's... All right, look at the NASDAQ breakdown here. Again, the Federal Reserve rate decision is going to be at 2 p.m. Eastern Standard Time. That's roughly 33 minutes. Again, it's widely expected for a 25 basis point cut, bringing the rate down to 3.75 to 4%. You know, we're going to see if we had any dissenters regarding this meeting. It's also going to be on, focus is also going to be again on QT and balance sheet adjustment. Many expecting alterations. So again, most likely 25 basis point cut today. In recent remarks, Powell said that a 25 basis point, hold on. Moran said a 25 basis point is too slow, but he does not think moving by more than 50 increments is necessary. Keyword more than, so he wants 50. Balance sheet adjustment. Rabobank and JP Morgan noted a couple weeks ago that they think the FOMC is likely to end balance sheet runoff. But it's not necessarily consensus, apparently. Many people think they will. They cited recent money market turbulence that could threaten interest rate control. Some see a gradual wrap up. Others anticipate a full halt, with MBSs likely to continue running off slowly due to the housing market conditions. Again, we'll see if he gives any forward guidance until November or to December. I mean, we can take a look at the SPY NVIDIA here. NVIDIA is still very green on the day, technically, here. Yeah, like, look, if we put up NVIDIA, previous closing price is here at about $200 a share for NVIDIA. So NVIDIA is green on the day. We also have big tech earnings, of course. You can take a look at Apple. Apple looks green on the day as well, just based off of tech strength. Yeah, here's Apple previous close. It's right above it. So Apple previous closing price is right here. NVIDIA is at about $200, so it's right here. So they're all green on the day. S&P, I'm pretty sure, is green on the day as well. If you look at the SPY here, all right, SPY is sitting all the way down here at 687s. So SPY is technically green. A lot of it gapped up. A lot of stuff's at all-time highs. Gold is right at $4,000. Look at gold. Right at 4,000 right now. Exactly at 4,000. Trying to hold over this now, but gold is decreasing here. It's dropping. So I think what matters is what the Fed does today. Well, I think they're going to cut rates 25 basis points, no? I mean, I could do a poll. I asked people, will the Fed announce an end to QT today? 59% said yes. 28% think in December. 13% think in 2026. Does anybody think we're not going to cut rates 25 basis point in chat, right? 25 basis points in chat right now. Does anybody think we're not going to do that? I think obviously the odds are low that we're going to pause, or I think the odds are even lower of rate hike or something like that. I don't think that's going to happen at all right now, considering the government shutdown. We're not getting economic reports. You think we're going to end QT in November? Yeah, but there's no rate decision in November. They might announce an end to it for November. If that's the case, they'll say, hey, we're ending quantitative tightening by November 30th. Right, that's how they would announce. If it was November, that's what they would do. But again, it could be the end of this month, could be December. All of that stuff's plausible. Guaranteed. What's up, Fox? The press conference is in an hour. The actual decision's in 30 minutes, less than 30 minutes now. So the press conference is in an hour. The actual rate decision is in about 29 minutes from now. And again, hit the live button next to the play button, put it in 2x speed. We will cover it as soon as it happens. And as well as we'll update you on what they're doing with QT. The Blaze. Yeah, I think a rate cut is already priced in. I think, again, you can kind of take a look at yields to see that. You know, yields have been sitting around 4% for weeks now. So yields are a little bit over 4%. They're actually a little elevated today, though. If you zoom out here, like here's the day for yields. You take a look at a 5-day chart. You can kind of see like yields are up slightly on the day. Yields and interest rates follow each other. And so, you know, yields since the 27th have been down 4%. They were at about 4.04%. The yields and interest rates follow each other. If you look at a monthly chart, most people are getting baked into an outcome of a rate cut. You can kind of see the move down in yields to 4%, which signifies that people think they're going to cut rates. Again, yields and interest rates follow each other. Yields and bond prices, supply and demand wise, inverse each other. Yeah, I mean, the VIX is probably kind of muted today just because, you know, we don't have a lot going on. The markets are going to be kind of quiet ahead of the FOMC meeting. But it is starting to rise leading into the meeting as volatility picks up. Really, the VIX is going to go up as the market moves down in volatility, most likely. And this could be some of the president's quotes that are going on right now, making the VIX go higher. But the VIX is almost at 17. Still low, though. It's still not necessarily high. I mean, markets are at all-time highs, so the VIX is not going to be elevated unless we get deep red action, just to understand how it moves. Yeah, I'm streaming the whole thing, the whole interview, the whole speech, everything live right here. We'll cover the rate decision at 2 p.m., the press conference at 2:30. We're going to stream it all live. FOMC decision, 2 p.m. Eastern. FOMC press conference, 2:30 is what it is. Yeah. High rates do not stop inflation. Well, they slow it. They don't stop it. Nothing stops it. Except a recession. Recession might actually make inflation literally decrease. Or might make inflation go negative, I should say. I mean, the logic of a rate hike combating inflation is this, right? Like a rate cut. When interest rates are lower, just to explain rate cuts and then I'll explain. When interest rates are lower, businesses can take out more loans and expand and do more things. People tend to spend more because they have cheaper, you know, they have cheaper interest, and so they tend to spend more, and it can make inflation spike. Printing money can make inflation really spike, though, through quantitative easing. Raising rates can combat inflation, but it does it slowly, and inflation's going to happen regardless. You know, it's never going to go down long periods of time outside of like crazy economic and market events. But yeah, the only time inflation literally is negative is during recessions or worse. Markets fade in the FOMC. Maybe. Sometimes the FOMCs buy the rumor, sell the news. I think it really depends on not just what Powell says, but what they do with QT today, I think is the big story. Like what they're doing with QT today, if there were any dissenters in the Fed decision, you know, all of that stuff is going to influence what happens here. So you just got to be ready. What do you guys think? Are you guys bullish or bearish today? We asked people, will the Fed announce an end to quantitative tightening? Again, 58% say today, 26% say December, 16% say next year. Again, the VIX is muted ahead of this report. Buy is up towards all-time highs. I think the S&P wants 7,000 though. Buy wants 700, S&P wants 7,000. Gold bounced right here at 4,000. So gold is holding a little bit, but it's down on the day. It was up to 4,030s this morning, maybe higher than that if I remember correctly. So gold still very green on the day, but fading back down a little bit. Yeah, it was almost to 50 today, 4,050. Pretty neutral. I want reversion today. I went mean reversion today instead of my usual breakout. Big teddy bear. Are you this bear though? See if I can turn. Let me spin it. It does. Okay. That just break. Oh, I turned my camera off. Okay, I was about to say. Are you this bear right here? I don't know if I've ever showed you guys my wall. Look at that wall right there. You know. I don't know if I've ever let you guys see what's actually in my office here. But I've got to build this office up over time. There we go, that's better. All right, we're in here. Bullish, pretty neutral. Quantitative tightening is the reduction of the Fed's balance sheet through letting their balance sheet mature and run off, letting what's in their balance sheet mature and run off, and not replacing it with new ones. That's basically quantitative tightening. It's passive QT is what the Fed's doing. But this helps bring interest rates higher. QT helps bring interest rates higher, right? It keeps interest rates a little bit more restrictive. It's combating inflation is the reason they did it. It started in 2022. Like, to understand this, and I explain this once every Fed stream, and maybe it's good to explain it. But what happens here, chat, is that the Fed, what happened in 2020 with the pandemic and everything that went on, caused inflation to spike. All the stuff that happened. The Fed was trying to save us from lockdowns and all this stuff, supply chain problems. And so the Fed stepped in and they lowered interest rates to almost zero. They printed a bunch of money as well through quantitative easing. We also had stimulus checks get sent out. A lot of stuff caused inflation. Right, supply chain problems. The net effect was inflation by 2 years later. 2022, massive inflation, almost 10%. And so then the Fed goes restrictive. They start raising interest rates, and they raised them like 400 or 500 basis points, if I remember correctly. And then they also announced quantitative tightening, the reduction of the Fed's balance sheet, as a way to maintain restriction at what a lot of people called restrictive levels in interest rates as well. And they've been doing QT since 2022. And so it is a restrictive monetary policy meant to combat inflation, but kind of push the economy down a little bit. And again, they're ending that most likely this year. No rate cut? I think that's very low probability. What's up, Faye? Watching from the sidelines. I'll probably trade the reaction tonight or tomorrow. Little chance of 50. Yeah, I mean, we're not cutting 50. That's basically not happening. Especially, like, look, we don't have any economic data. And you guys know me, I always cover economic data. It's been kind of boring for 29 days now because we haven't had economic data to gauge what's going on in the U.S. economy and inflation. But because we don't have that data, as well as the fact that ADP, which is a private data releaser, has released some data that showed the labor market wasn't terrible, it wasn't the worst it could be. I don't think 50 basis points is going to happen at all. I just think that's such a low probability. 50 basis points is probably not freaking happening. Now, we're probably going to cut 25, and we might announce an end to quantitative tightening today. But, you know, again, anything outside of that is pretty low odds. Anything outside of a 25 basis point cut, pretty low odds, you know. And again, you don't want to fall for it. Some people just want to sensationalize things. So they're going to say, oh, are we going to pause? Like, are we going to cut? They're just trying to get you to click. Be smart. Understand 25 basis point cuts, pretty freaking likely. And anybody that's acting like it's not is usually just trying to sell you something. So just be smart. Understand what it really is, you know. And again, objectively, that's what it really is. Yeah, what we do next year, I'm not sure in terms of cuts. We can take a look at the odds here. So if you want to look at the odds for what we're doing right now and what's technically priced into the market as we speak, at this point in time, it's looking likely that we're going to do 25, 25, 25, right? And so what does that mean? That means 25 last meeting, 25 today, cuts. These are cuts. And then 25 the next meeting after this one in December, right? This is the most probable outcome for the year. And if we look at the odds right now, we take a look at the odds, 98% chance of a 25 basis point cut today. That would be this 25 right here. Again, 98% likely that we're going to cut rates 25 basis points today. If we go into next meeting, which is in December, because remember, the meetings happen every 6 weeks. But they're not once a month, they're every 6 weeks. If we go to the next meeting, at this point in time, we got 85.5% chance of another 25 basis point cut, bringing the target range to 350, 375 right here. Right, so that would be 25, 25, 25. That would be 25 last meeting, 25 today, and then 25 in December. That's the most likely outcome as of now. This could always change. If the government reopens and we get high inflation PCE, if we get strong labor market, high payroll numbers, good GDP data, JOLTS comes in strong, ADP shows strength, then that might sway the odds of a rate cut in December. That doesn't necessarily mean we're, that's what's going to happen. But, there's a lot of ifs that have to occur for that to be the base case, I would think. And again, outside of this stuff, the big thing you want to pay attention to today is what Jerome Powell actually says during the press conference. Like, you want to listen to what Powell actually says during the FOMC press conference today. That's going to matter a lot. That's going to influence. Yeah, if we end QT, it's probably bearish. Somebody asked about the dollar index. If we end QT, it's probably bearish for the dollar. Just because it's a more dovish thing, makes inflation potentially worse. All right, guys, NASDAQ's creeping back up ahead of this meeting. We still got about 20 minutes left until the actual decision. And again, we're going to cover everything. Specifically, they'll show you whether here's the last statement from last meeting. This is where they talked about quantitative tightening. If they end QT or have any update on ending QT now, it's going to be in this section probably. Now, if they do not end QT today, or announce it into QT, I should say, then you want to listen to what Powell says during the press conference. He's probably going to talk about it at least a little bit during the press conference. I'm sure they're going to reference the shutdown and everything going on in that context too. So we've had enough time to fix the supply chains. Yeah, the supply chains are fixed, brother. What you got to understand about inflation is that it doesn't decrease. Inflation does not go down. Like, people are still saying, hey, look, we still have these high prices. You're going to still get high prices. Inflation doesn't go down, brother. Unfortunately, I wish it did. But we can take a look at a CPI inflation graph, and I talk about this a lot. It's surprising how many people think prices literally go down often. Look, the best we can do is hope to slow prices down. Here's a CPI inflation graph over 20 years. 20 years. The only time prices really go down is when we enter recessions. Here's 2008 financial crisis. The only time prices actually went down, and they didn't stay down there for long. Maybe a little bit of negative inflation here, but it certainly didn't last long. Again, the best we can do is hope to slow the increase of prices down. Get a couple break-even sessions. That's what we can hope for with the most optimism. Outside of that, prices aren't going down, bro. Food prices maybe. Gas prices sometimes, depending on stuff going on, supply and demand and Middle East stuff. But outside of those two things, we're not really going to see price decreasing. Not regularly, not often. And if we do see prices going down, we usually got a lot bigger problems on our hands regarding recessions and, stuff like that. Alright, guys. I'm gonna have to get some exciting songs in. Yeah, we got a 99% chance of a rate cut today. Alright. $7,000 on the E-mini. Yeah, we'll see. We got 15 minutes. Still got 15 minutes before the rate decision's announced, guys. So we still got time. Um, All right, again, we got the FOMC decision live. Just be ready here, chat. Again, we got about 15 minutes left until the actual decision comes out. Really about 14 minutes. And again, just be ready. Like, again, if they end quantitative tightening, we could see swings. A lot of this outcome is already baked into the market. Meaning a lot of this is already baked into everything. You know, so if we do as expected with everything, like we do a 25 basis point cut, we announce an end to quantitative tightening later this year, maybe we'll get some movements on the QT news. But a lot of this is already baked into everything. Be smart, be careful. Don't make too big of crazy bets. A lot of it's going to depend on what Powell actually says during the FOMC press conference. What happens if it's a 50 basis point cut? I mean, I think markets might run on that news, but I think that's very, 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 very low probability. I just don't think that's going to happen. No. You know, government's closed. We don't have economic reports right now. And so the likelihood that we're going to have a 50 basis point cut, which is a big decision to make, right? Like the likelihood that that's going to happen is very, very low. It's almost impossible. It's not impossible. It's super, super low. Super, super low. Even a rate cut, even a pause is unlikely. Right? It's very unlikely. It's probably not going to happen either. The pause in interest rates is probably not going on. Clarify. All right, guys, be ready. Time. Again, the clock's ticking here, chat. 12 minutes. Hit the live button next to the play button. I'll put it in sub only mode maybe later, but 50 basis points means something is wrong. Yeah, I mean, I don't know. I don't think it's gonna freak investors out like that. We don't really have the data to gauge it, right? So 50 basis points historically could mean something's wrong, and the larger the rate cut, the more dire, panicky markets might react. But I don't necessarily think if we did 50 today, markets would panic. I think markets might actually like it. It's all speculative though. Like we're all guessing here. That's what markets are, is guessing. So, and again, will they end quantitative tightening today? That's the big story. Again, here's the last statement. This is where they talked about committee will continue reducing its holdings of treasury securities and agency debt, and agency MBS is strongly committed to support 2% inflation and all that stuff. So that's where they'll say that if they're ending it directly today, that's where they'll say it. And again, we're going to cover it as soon as it drops. Markets would skyrocket hard, baby. They will announce a cut in 11 minutes, most likely. They will announce a 25 basis point cut in 11 minutes. Again, you could bet against me. I don't think it, you know, I don't know what the odds are outside of the CME watch tool. 99% likely of a 25 basis point cut in 11 minutes. If they don't do a rate cut today, Bitcoin might fall under 100K. That might be true. I don't know though. Yeah. Okay, we got the FOMC decision live pretty soon. Be ready. Again, we got 10 minutes into the actual decision here. Any reason for markets to fall a bit today since the start of the day? I mean, today's a FOMC decision day, so markets are usually going to be stagnant leading into this report. We're usually going to get stagnation leading into this report. Yeah, I don't think we're doing QE today. I don't think we're going to start printing. We might announce an end to quantitative tightening, but QE is not the same thing. Ending QT means they're going to keep their balance sheet the same, meaning if certain things mature, they're going to just buy another one and replace it versus actively expanding their balance sheet through money printing versus reducing it in QT, right? Like, again, ending QT doesn't necessarily mean QE. Again, Jerome Powell is going to be speaking live at 2:30 p.m. Eastern Standard Time after this rate decision. So 2:30 p.m. is when Powell is going to start speaking. Again, if everything's already pretty expected for a rate cut, if a rate cut's already pretty freaking likely, what it means is that attention's going to pivot to what Jerome Powell actually says during this, right? We'll see if he gives us an update on when we're going to do things. Government's still shut down, by the way. We'll see if we get an update towards all that stuff. You know, again, we'll see. We gotta wait. Didn't Powell claim last that the Fed are already in a neutral position? He said they were somewhat neutral. I think close to the neutral rate. Again, 8 minutes, chat. Hit the live button next to the play button. Put it in 2x speed. We'll cover this live as soon as it happens. Nasdaq starting to push up. We're at 26,264. Again, all-time highs are not that far out of reach today. All-time highs on the Nasdaq are at 26,327 currently. New all-time highs up here. Right here is the all-time high on the NQ. So we're getting up there now. Again, I don't know if this is going to move things. We still have 7.5 minutes left until the actual rate decision. I'm thinking about NQE in December, maybe. Baked into the cake. Yeah, I think a 25 basis point cut's already pretty close to baked in. I mean, I don't know how much, but again, 7 minutes left. 7 minutes. Again, the procedure here is at 2 p.m. Eastern time. The rate decision is announced at 2 p.m. Eastern Standard Time. At 2:30. Is where we're gonna get the accompanying Jerome Powell press conference. So, somewhere around December, Q1 of next year. Yeah, I could probably agree with that. Again, if they do announce it today, they could say a couple different things. They could say, "Hey, we're ending quantitative tightening, and it's going to end at the end of October," or "Hey, we're ending quantitative tightening, it's going to end at the end of December." Or November, or they could say, "Hey, we're gonna slowly begin the reduction of quantitative tightening," right? Or they could basically just say, "We don't know when it's gonna end. We're just gonna gradually reduce it." That's possible. So again, 6 minutes left, chat. All right, guys. Hey, we got about 5.5 minutes. Jerome Powell's going to be direct. Slowly, gradually. This seems more like Jerome Powell style. Yeah, I mean, it's possible it's like that. Again, Powell is very cautious. A lot of people would say. Cautious Powell, potentially. So, we'll see. I guess we'll for sure hear about uncertainty. Oh, we're definitely hearing about uncertainty. We're definitely going to be hearing about the government shutdown. He's going to say, my guess is Powell will say something along the lines of, the the government shut down. We're not getting economic data like we need to in support of this, you know, blah, 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 blah. He's going to say something. He'll probably say we're going to be cautious and do a 25 basis point cut and then be data dependent moving forward. Refusal to give a base case after today's meeting. Now, that doesn't mean we're not going to end quantitative tightening. But I'm sure he's going to say something along the lines in terms of risk management and, hey, government shut down. We're not getting data. All that good stuff. Yeah. All right, guys, we got about 4.5 minutes. Oh, he's wearing a purple tie today. I mean, a purple tie is almost given. Powell doesn't deviate from a purple tie. My guess is he doesn't want to give a market direction. If he wears a green tie, people freak out. If he wears a red tie, people definitely freak out. So what does he do? He picks kind of a neutral purplish tie. You know, I'm an LSU fan, so I'm okay with that. You know, but purple tie Powell is a real thing. Again, give me your last bit of predictions. We got about 3.5 minutes until this FOMC decision. 3.5 minutes. Yeah, 3.5 minutes. Let's do this. Here we go. Hit the live button next to the play button. Make sure you catch up to the stream here, chat. Again, Jerome Powell is going to be speaking live at 2:30. But the actual decision is going to come in about 3 minutes. All right, guys, here we go. You guys ready? Again, do you guys think there's a chance we pause today? We'll figure out in a couple minutes. Do we pause today? I don't know. I don't think so. But that decision is about to be live right now. Be ready. Let's prepare ourselves. Again, the big question is, do we end quantitative tightening? That's what I'm looking at right now. Do we end QT? Does QT continue? It's time. Quantitative tightening continue. You ready? We got 2 minutes. We got thousands here. We appreciate you guys. QT will continue. QT will end. 100% QT8 ending today. I mean, I'm not really worried about what markets. Charts are going to be flat right now. We're ahead of the FOMC meeting. Most of the time, markets are going to be flat right now leading into it. So. Okay, guys. Here we go. And today, 10:29. We got 1 minute left, chat. 1 minute. To get ahead of this report, I'm going to put it in sub-only mode. Oh, it already is in sub-only mode. I thought I took it off of sub-only mode for the stream, but that's all right. All right, guys. Here we go. Again, put it in 2x speed. If you put the stream at 2x speed and put it in, and then click the live button, you'll be on time for this. 40 seconds. $30 seconds. $20 seconds. Here we go. 10 seconds. Timer's a little bit early. All right, a little bit early. And here we go. Here's the report. And there's the decision right here. Okay, yeah, it was a 25 basis point cut. Available indicators suggest that the economy activity has been expanding at a modest pace. Job gains have slowed. this year, and unemployment has edged up and remains low through August. In support of these goals, the committee decided to lower target range for the federal funds by 25 basis points as expected. 25 basis point cut as expected. The market didn't really move. Again, let's look to see if they ended quantitative tightening. The committee decided to conclude the reduction of its aggregate security holdings on December 1st. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% target. Okay, so they are ending quantitative tightening on December 1st. They're going to be ending QT on December 1st. That is going on. And again, I'll read the full statement here. But yeah, they're ending quantitative tightening on December 1st. I told you guys what would happen today. I tried to tell you. Nobody listens. But again, here it is right here. I'll read it. Available indicators suggest that the economy activity has been expanding at a moderate pace. Job gains have slowed this year, and unemployment has edged up and remained low through August. More recent indicators are consistent with these developments. Inflation has moved up since early in the year and remains somewhat elevated. All right, so December 1st, 2025. December 1st, 2025 is when they're ending quantitative tightening. Again, they say the committee seeks to achieve maximum employment inflation 2% over the long run. Uncertainty about the economic outlook remains elevated, is attentive to the risks on both sides of its dual mandate, and judges downside risk to employment rose in recent months. In support of this goal, shift to balance, 25 basis point cut, 3.75% to 4%. Again, the committee decided to conclude the reduction of its aggregate security holdings on December 1st. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. The Nasdaq hasn't really moved at all. So that shows the markets are basically baked into this. Again, Feds ended QT starting December 1st. Cut rates 25 basis points as expected. So I told you guys this is what was going to happen. We didn't get the dot plot today, did we? Let me make sure. I don't think we did. Let me make sure. Clarify. Predictive analysis. Yeah, I mean, again, this is pretty likely going to happen. Again, it was pretty unlikely that the Fed was going to, do anything outside of a 25 basis point cut. I try to tell people this. Again, we're going to stream the FOMC decision live, so stick around. We will stream the entire decision live as it happens. Gold gains. Yeah, gold up. Nasdaq heading down a little bit here. Yeah, the Fed speech is in. I'll put a timer up for the Fed speech. We're going to stream the whole thing live as it happens. Again, so stick around. We'll stream the whole thing as soon as it happens. It's in about 24 minutes. 25 minutes, give or take. So, again, we will stream the whole thing live. There's the countdown timer. Yeah, so the only thing we've gotten so far is this statement. The market hasn't really moved much. Again, this statement was the only thing we've gotten. I was checking. Today's not the dot plot. But again, the only real news we got, available indicators suggest the economy is that economic activity has been expanding at a moderate pace. Job gains have slowed this year, and unemployment has edged up but remained low through August. More recent indicators consistent with these developments. Nasdaq's starting to fade down some, though. We had 2 dissenters. Moran voted for 50 basis points, and Schmid voted for no basis point cuts. Again, 2 dissenters, 1 for a 50 and 1 for no cut is what we got today. We're starting to rebound a little bit here, though, in the NASDAQ, but the NASDAQ is basically flat here. And again, we got about 25 minutes. We'll stream the whole thing live. NASDAQ is really unchanged. It really hasn't moved much from this report. But again, the Fed cut rates 25 basis point as expected. 2 dissenters. Moran voted for 50 basis point cut. Schmid voted for no cut. But we're not really getting any like market reaction on this. But yeah, Fed ending QT starting December 1st. That's in about 30 days or so. 30 days. I'm curious to see what Powell says regarding all this stuff. But again, the Fed is ending quantitative tightening, which is the reduction of the Fed's balance sheet, December 1st, 2025. We did get an update in that here. And this is where I told you guys it would be. Committee decided to conclude the reduction of its aggregate security holdings December 1st. So, still got about 20 minutes left. Is the music too loud? I can turn it down a little bit. My bad. There we go. Yeah, let me know if that's good. I can always turn it. I mean, we got the press conference coming up in 20 minutes, right? So I don't want to reduce it too much to where, you know, you can't hear the press conference. All right, guys, we got the FOMC press conference going live in 22 minutes. Again, the full conference will be streamed live here. Here's a timer. NASDAQ is starting to fight its way back up a little bit here, to be honest. Starting to fight our way back up. Honestly, the volatility we're getting from this is very, very low. I mean, as expected, 25 basis point. What Jerome Powell says during the actual press conference will matter a lot. But, I mean, I can turn the music down. You guys want music or no music? Let me know in chat. Music or no music? Music, no music, 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 no music, no music, no. Music is cool, silent is boring, music, no music. Bro, I can't make everybody happy here. Man, the chat's going wild on the music question. Maybe I should ask that question more. Keep it low. Damn, dude, I've never seen the chat move this fast with this question, brother. Again, should I turn the music off? I'm gonna keep asking it. Okay, yeah. I think the only way we could solve this is a poll. Wild. Y'all are crazy. Should I turn the music completely off? All right. There's a democracy in here, okay? Vote on the poll. Let me know what you guys think. I can't even read the chat. I can't even read what you guys are saying. There's too many comments. Vote on the poll. There's a democracy going on. Music is part of our community. How many people are in here? 2,100. Should I turn the music completely off? 44% say yes out of 300 votes in about 30 seconds. Who knew the polarizing question today would be whether I should play music? I got some better music if you guys want. Just a little bit too poppy for me. I don't know where this music comes from. Let me find better music. Hold on. All right, guys, we got 20 minutes here. DJ John. The meeting's in, again, the meeting's in 18 minutes. We're going to stream the full meeting live as soon as it happens. Here, in fact, I will put this up. Here, I got you guys. Hold on. Let me make sure I get this right. Alright. Oh, I thought that was, I didn't know what that was that went across the screen. Okay. There's Nvidia. I can put like gold up here, maybe the dollar index. Did the dollar index fall down on the quantitative tightening announcement? No, it's actually up a little bit. I thought we'd get a bigger reaction to ending quantitative tightening, but I guess not. I thought we'd get a bigger reaction here, but nothing. All right. 55% say no, man. We're so polarized on this. Here, I'm gonna end this poll. You've had a chance. Here, look. I will do a new poll. Powell have a hawkish or dovish tone this meeting? I'm gonna do hawkish, dove, and then neutral as an option. Vote on the poll. Let me know what you guys think. I mean, I wouldn't even call this sell the news. I don't think this reaction is very strong. I think that's a pretty small reaction here. Yeah, I don't even think this is a big reaction. I think it's a very small reaction. I've done a lot of this stuff. QT doesn't mean ish around here. Got it. What color will Powell's tie be outside of purple? Anybody think he won't have a purple tie? What are the odds on that? I think it's pretty low. Yeah, I'm looking at some of the stuff. Again, Fed ending quantitative tightening on the 1st of December. Again, U.S. short-term interest rate futures fall after Fed decision on traders. Here bets on further rate cuts. Yeah, let's see where yields are now after this decision here. Their yields are up a little bit. Let's see. Yeah, yields have actually gone up on the decision here. Here's yields. That's 10-year treasuries. Fed says Schmid dissented in favor of no rate cut. Again, Moran dissented in favor of a 50 basis point cut. Again, Fed's going to end quantitative tightening on the 1st. They cut rates 25 basis points. JP Morgan's Michelle says have to separate crypto and stablecoins. Tariffs are yesterday's news for companies. Powell is losing his grip on the Fed. Think you have to put Bessent in Fed, have him lobby. I don't think Bessent wants to be Fed. Looking at our poll numbers, we asked people, will Powell have a hawkish or dovish tone? 42% think Powell's going to be dovish here. 42%, which is a pretty high number. All right, guys. Again, stick around. We are going to stream the entire press conference live. Hit the subscribe button. Put it in 2x speed. Again, we're sitting here waiting. It's still not, press conference still hasn't started. We'll cover it live as soon as it happens, but we got to sit tight and wait. Again, 25 basis point cut. Fed ending quantitative tightening starting December 1st. Nasdaq's so slow here. Dollar index is up. Yields are up. Gold under 4,000 here. Look at gold. Gold just dipped under 4K. Nasdaq is really unchanged. I mean, the decision came out. It was at 26,260. It's now at 26,35. So it's basically unchanged today. How many times does Powell say dual mandate? Leg's okay. Yeah, I tore my MCL 4 weeks ago. I'm back to basically full range of motion, but I'm still trying to learn how to walk back normal. Like I'm nervous to put weight on it, even though it's fine. I went to a PT yesterday. They said it's fine. Weird, you know. It's weird to try to walk normal. Again, 41% think Powell's gonna have a dovish tone. 32% think hawkish tone. 27% think a neutral tone. Powell won't throw a bone to president. He'll be cryptic but suggest inflation and labor. Yeah, I mean, is it stagflation? Do you guys think we're in a stagflation environment where inflation is elevated and we have weak labor? What do you guys think? Are we in a stagflationary environment? I don't know, man. I think we could be. Generally speaking, stagflation precedes a recession, just to clarify for everybody at home. I don't know. Definitely stagflation. Labor's dropping big time. Yeah, I think we're seeing a lot of weakness at labor. We saw it prior to the government shutting down with the NFP report being low. Revisions to the NFP and labor report. Unemployment ticking up a little bit. You know, we've seen a lot of big revisions to labor, and I think that's what started this rate cut cycle to begin with. You know, last meeting, 25 basis point cut and ending QT. I think that's all because, you know, rates need to be lowered to kind of edge against weak labor. Now, I think there's risk to both sides, though. In a stagflation environment, sometimes precedes a recession, which is high inflation and weak labor. But I don't think either one of them is too obvious right now either. I think we're obviously seeing some weak labor. We have inflation sitting around 3%. 3% is not the worst it could be. You know, a lot of people think 2% is like... I don't think 2%'s... Anything over 2% is not bad. You know, like anything under 3 is decent, I think, in terms of inflation. It's just... we can't read into the future. I'll bet neutral. Yeah, I think neutral makes sense. One more dip, then one more top, then big recession. Who says we have weak labor? Economic data does. The non-farm payroll report, the JOLTS job report, the ADP non-farm employment change data. Jerome Powell, president. A lot of people consider we have weak labor. Again, it's not. I'm not a political guy. I'm really not. I don't care about either side. You know, they're all the same once you get to the top. Like, I'm not political at all. Labor markets, labor reports have been weak lately. It's hard to tell because the government's freaking shut down, so we don't get the labor reports over the last 30 days. But prior to the last 30 days, they were weak. So. Yeah, maybe weak labor means lower future inflation risk. Generally, they correlate negatively off of each other, so sure, that's possible. We've also seen high inflation, though. Inflation came out Friday. It did show a little bit of an uptick. It's not... Look, headline CPI was 3%. Last time was 2.9%. The rest of it was lower than expected and lower than last time, though. Month over month, lower than expected, lower than last time for core and headline, month over month. And then headline month over month was also lower than previously and lower than last time. The only one that was higher was headline year over year in CPI on Friday, but it's still around 3%. So people can still consider we have inflation issues. And again, if you look at a CPI inflation graph here leading into all of it, you know, if you get a CPI inflation graph leading into all of it, you know, year over year has seen an uptick since April. You know, here's April. That's April. We have moved up a little bit since then. Year over year headline. Now, core is a different story. A lot of people would argue core is a more valid look. But yeah. Can I have a do-over on the poll? Nah. Sorry, bro. GM just laid off thousands of people. I saw that news. I'm in HVAC industry, dismal industry, down double digits month over month over month. Not my house as HVAC employees. You know, the guys we got coming out to my house, they better be getting paid because we're spending money on the freaking HVAC system here. And I just bought a new AC in my rental property. You know, so cost me freaking $8,000 something dollars. Is that reasonable? 8.5K for a new HVAC system. It's a 2-story home. You know, I was still mad about paying it, but I don't know how good of a deal I got. We had tenants in there, so we had to get it done quick, so I just didn't haggle. Okay, good. Yeah, it was a rental property. The one for this house was much more, so. Yeah, so let's take a look at the odds for cutting in December. I hear some people talking about it, right? The odds for cutting in December are at this point in time 90%. So at this point in time, it looks like we're going to do, like I told you guys this months ago. We're going to do 25, 25, 25. That is what we're going to do most likely. Now, you could argue we're not going to do that. A lot of people argued we weren't going to get a cut today. I'm not going to say I told you so, but I freaking told you guys so. It's very easy to predict this stuff. It's not like I'm a genius, you know, top 3 most genius people ever, but it's not hard to predict this. Of course, we're going to cut 25 basis points today. If the odds are 99-1 and you're picking the 1, why? Makes no sense. Why are you betting against the super likely outcome every time? It just doesn't make sense. I'm not criticizing you. But why would you ever do that? $25, $25, $25. That's what we're doing. All right, guys. Hey, 5 minutes. I tell people this every meeting. Why are you picking 25 basis point? Like, why are you picking something that's 1% chance happening and acting like it's a certainty? You know? I'm gonna call you Chicken Little. That's what I'm gonna call you. Sits in your AC unit. Yeah. I got a property manager. All right, guys, here we go. Look at the camera shaking. People like to, yeah, they like to be contrarian is what it is. Take a look at Bitcoin despite all the stuff going on here. Here's Bitcoin, guys. Bitcoin's still down at 111s. I would assume Bitcoin might like the easing, or not the easing, but the reduction. I would think Bitcoin would like ending quantitative tightening in December. But Bitcoin is essentially unchanged from this thing too. Weird. I think he's going to start with good afternoon almost certainly. 9-3. I think it's almost certainly going to be good afternoon. Will he cough more than 5 times? Will he cough more than 5 times? Yeah, I don't know. In the rate decision is already out. We did 25 basis point rate cut. 25 basis point rate cut today. Ending quantitative tightening starting in December 1st. We got 3 minutes left, chat. 3 minutes left. Hit the live button next to the play button. Put it in 2x speed. And hit the live button. Put it in 2x speed. And I'm going to mute the music now since half the people here apparently hate the music. And I'm personally offended by that. But that's all right. All right, listen. For you guys, I'll end the music right now. I'll unmute this. If you don't like my music, you should listen to the Fed's music they got playing in the background. All right, guys, here we go. 2.5 minutes. What does a dove tone do to the markets? Maybe it makes the market go up. I'm not sure. A dovish tone by Jerome Powell could be seen as optimism and make markets go up. I'm also going to raise the volume here so you can really hear it. Live as it can be. All right, we're ready. We got about a minute and a half. What's your opinion on MicroStrategy? I like MicroStrategy. I don't know what it's going to do, but I like it as a company overall. Yeah, here's no music, guys. This is what you guys wanted. Well, it's not bullish enough, of course, as it's just about to stop QT. That means market needs to wait till January when they start QE and market. Yeah, I don't know if you're talking about Bitcoin. I don't think we necessarily need to do QE. Why should we do quantitative easing right now? Give me a good argument for it. I'll listen. I'm not against it. I mean, I don't want to do it because it'll cause inflation. But what's your argument on why we should do quantitative easing right now, outside of you want crypto to go up? I'm not against you. I want crypto to go up too. I just don't know if I want to do it through quantitative easing. Quantitative tightening is the reduction of the Fed's balance sheet through letting their current holdings mature and run off and then not replacing them with new ones. The restrictive monetary policy takes liquidity away from markets. All right, guys, here we go. It should start about 10 seconds. Let's see the... All right, here we go. They're ending the music. All right, guys, here we go. Purple tie.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. how are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we'll expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths. And so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard?
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or a similar thing. We are, if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there. So.
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
So on that division, then, you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth.
Thank you so much. Elizabeth Scholzley with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and so the unemployment rate has gone down, meaning that demand for workers is going down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work is pretty close to zero. So maximum employment doesn't, on a sustainable basis, doesn't, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. But others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI, of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about, it's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria.
Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that, and has been growing, and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers, or maybe skewed that way. But the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You can point to growth. I mean, actually, you may be growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs, because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right, that you could also argue, well, things haven't really changed. But you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting, we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago, you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, in no story, you can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable, those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney.
Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. we're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this. And I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending. But it wouldn't be, you shouldn't think that it'll, dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
All right, guys, so that is Jerome Powell here. NASDAQ's mostly flat from this report. Powell ended quantitative tightening, very hawkish tone. I see some conversations we're having in the chat. Like, one of them is, I still think we're cutting 25 basis points in December. When I said the contrarian argument, I said everybody wants to be contrarian and vote on something that's 1% likely. Odds of a December rate cut were never 99%. So I was talking obviously about a 50 basis point cut this meeting, which is just a wild, ridiculous, like, wannabe contrarian bet, or a pause this meeting, which is less, it's better odds, but it's still pretty freaking improbable. And again, I told you guys this before, what we would do today. We cut 25 basis points as expected. Not really a shock to see that happen. A 25 basis point cut was pretty priced in. I don't know why people bet against the odds every time. If something's 99 to 1% 5 minutes before the meeting, why are you betting on the 1% chance? It's just, it doesn't make sense. Yeah, I mean, I still think we're cutting 25 basis points in December. Like, me saying the most probable outcome is a 25 basis point cut is not wrong. Right now, a 25 basis point cut in December is the most probable outcome. At this point in time, it is 63.4% likely that we're going to cut rates in December. Doesn't mean it's not going to happen. It's just the most likely outcome right now. And I still think they're going to do 25. Look, Powell said the same thing last meeting. Last meeting, Jerome Powell said what? He said a rate cut in October is not guaranteed. Today's October. 25 basis point cut. And so I'm not saying we have to cut rates in December. Look, things could always change leading into December. What could change? Well, we could have weak labor. We could have, we could have high inflation, strong labor. Those would push back odds of a rate cut in December. At this point in time, it's pretty freaking likely we're going to cut rates 25 basis points in December, though. And again, this is always subject to change. If we get strong labor making rate cuts less needed in December, we might not cut rates. We ended quantitative tightening, which is going to end December 1st in a month. And again, we get strong labor. We get strong jobs reports. If the government resumes, that is. Like, say the government resumes, we get the late labor report from last month. We get the late labor report from this month. We get, the JOLTS report, which is pushed back. We get updates to ADP. Even if the government doesn't resume, we'll still get ADP next week, Tuesday and Wednesday. And so we got some stuff going on this week and next week. But unless we get like a big change to labor where it shows strength, as well as we have high risk to inflation increasing and we get inflation data. We don't really have an inflation data that can come out. So we don't really have inflation data come out to change the tune for December if the government doesn't resume. And even if it does resume, it might take them a little while to get things organized. So we'll see what happens. But again, I still think 25 most likely makes sense. And I think that's probably going to happen. It doesn't mean it's going to happen. It just means at this point in time, right now, it is the most probable outcome. It's 25. I don't think that's a shock. Look at gold breakdown here. Also, guys, check out Top Step. You want to help support the channel. No PDT and futures. You can day trade the S&P, NASDAQ, Dow, Russell, gold, some currencies. Great way to learn how to day trade when most day traders lose money. Very useful. Top Step gives you a 50K demo. They test your skill with it. You pass the test. They fund you 50K. You fail, you lose $50. Best of both worlds. 90% split once you're funded. Beautiful way to learn. They have their back to funded option. You can reset funded accounts and all that good stuff. I'll put this link up. I'll pin it to the top of the chat if you want to check it out. There's the link. I appreciate it. We also, in 30 minutes, guys, 30 minutes, we have Meta, Google, Microsoft earnings going live in 30 minutes. So stick around. Remember, I'm not an investment professional. Nothing I say here is guaranteed. I might be wildly wrong about anything and everything I say, and I'm sure some people might agree with that today. Maybe I'm wrong about a lot of stuff. I don't know. I wasn't wrong about what today's decision would be, though. I told you guys 25 basis point cut. I told you guys we'd probably announce the end of quantitative tightening today, which we did. And again, we'll see what happens. Nothing's 100% in markets, guys. You guys know this. Nothing's 100%. And we'll see what happens, guys. Again, as soon as I close this stream, it should immediately bring you to the next stream for Meta, Microsoft, and Google earnings. Again, we got 30 minutes until that earnings report goes live. Gold is now technically red on the day. So again, I'm going to end the stream. Immediately it's going to bring you to the Meta, Microsoft, Google stream. So you won't have to go anywhere. I'm just going to dedicate my own stream to it. Yeah, I'll see you guys. Again, I'm going to close the stream. It should immediately bring you there. I'll be there right now. I'm starting the stream right now, so you won't have to wait there long. All right. So again, give me a second. I'll start that stream. Redirect is working. Check this. Make sure. There. Okay, good.